Hello AP Econ, this is Ms. Haley and welcome to Macro Flip Videos. So this is part 2 of video 11 on monetary policy. And last video we talked about how to create the demand and supply curves for money and who controlled both the demand and the supply. And so now that we have an understanding that the central bank or the federal bank of the US or the central bank of Jordan alters the money supply, we're going to look at one specific part of the central bank altering the money supply, and that is open market operations. So in open market operations, the central bank can increase or decrease the money supply by purchasing or selling bonds. So we remember from the last video that bonds are basically an IOU. So if I wanted to start my own coffee shop, I would have other people buy bonds, I would sell them, and so then I would be gaining money. So in this sense, we can think about how when the Fed wants to increase the money supply, so they want to give money to financial institutions, they are buying those treasury bonds. So they are actually loaning out money to other people to increase the money supply. And then when the Fed wants to take money away from the money supply, wants to shift that inelastic supply curve to the left, then they're going to actually sell treasury bonds and take that money in themselves. So Fed, when they're buying, it increases the money supply. Fed, when they're selling, it decreases the money supply. We definitely want to have this understanding to continue. So now we're actually applying it to graphs. Remember, we have the demand for money is downward sloping because the inverse relationship between interest rates and quantity of money. So we have a downward sloping demand graph for money, and that could be shifted by people's increase in income, the increase in price levels, or the change in technology. So if credit cards are a lot more common, then people would need less money on hand. And so remember, with the money supply, it's shifted by the Fed or the central bank. And whenever the money supply is increased, so this perfectly inelastic curve is shifted to the right, we see it's called expansionary monetary policy. And so if the Fed increases the money supply, remember we saw that when they are actually buying bonds, so the purchasing of bonds by the Fed shifts the money supply to the right, and that will decrease interest rates. And so how does this affect aggregate demand? Because remember, we're connecting both not just fiscal policy, but also monetary policy to aggregate demand. So if we have a decrease in interest rates, you all might already be connecting this to investment. And so if we have a decreasing interest rate, people want more quantity investment, and then that will increase AD overall, because remember, AD is made up of the equation SIGNIX, so consumer spending, investment spending, government spending, and net exports. So to walk through all those changes together, again, we said that if the Feds are buying bonds, that they're putting more money into circulation. They're not printing more money, they're just taking money that was owned by the Fed off into the economy that financial institutions can access. So increase in that money supply decreases interest rates. And so then people are going to want more quantity of investment because there's lower interest rates. And then we're going to see a shift, an increase of aggregate demand from the increase in investments, increase in quantity of investments. And so what we see, if there's an increase in quantity of investments, the changes are twofold. So we have a higher price level, so slight inflation, and we also have a higher quantity of GDP, which we can connect to an increase in employment, so less unhealthy unemployment. So this is, again, when the Fed is increasing the money supply by buying bonds and giving money to financial institutions. So now let's look at the opposite. So what does it look like, and how does the Fed or the central bank decrease the money supply? So again, it's not like they're taking money and putting it through a shredder. That money still exists, but now will be owned by the federal bank. So this is contractionary fiscal policy. So if the Fed is decreasing the money supply, which let's go back and see how does this happen. This is when the Fed is actually exchanging bonds, or they're selling bonds. So the Fed is selling bonds to financial institutions and then taking that money out of circulation. And so when the Fed is buying those bonds, when the Fed is selling those bonds, taking the money out of circulation, there's a decrease in the money supply, and we have an increase in interest rates. So from our last example, we can realize that a decrease in the money supply and increase in interest rates would lead to less quantity of investment demanded, and then a decrease in aggregate demand. So again, when the Fed is selling the bonds, and so they're taking more money back into the Fed, we have a decrease of this inelastic supply curve, an increase in interest rates, And so if you're someone saying, do I want to invest or not? Well, when we see an increase in interest rates, we're not going to want to invest as much. And we're going to see a decrease in aggregate demand, because remember, aggregate demand is representative of GDP, which is C, I, G, and NX. So we have a decrease in I. And seeing the shift of aggregate demand to the left has, again, a twofold influence. So there is a decrease in price levels, so deflation, and then there's a decrease in GDP, and so we would also see increase in unemployment. So the last small flip video that you all are going to watch tomorrow, we'll talk about what those influences of monetary policy are, and not just looking overall at the increase in aggregate demand from expansionary monetary policy, which again is when the Fed is buying bonds. We're going to see how these other impacts relate to each other. So how the fact that we have a higher real GDP with expansionary monetary policy, there's lower unemployment and higher price levels. What is this relationship between unemployment and price levels, and is it always consistent? So thank you all and have a great day.